GM, good morning. Welcome to the Milk Road Show, the daily crypto show that's as satisfying as a midnight snack. I'm your co-host, Kyle Reedhead, and today we are joined by Kyla Scanlon, author of the book, In This Economy, How Money and Markets Really Work. And in today's episode, we'll be answering what is the role of the Fed in the economy? What have they been doing? What are they doing now? And what do we think they're going to do in the future? And how is that going to impact markets? Before we get into the episode, we are running a raffle right now. 56% of our viewers aren't subscribed. So please subscribe by the end of August and you could win our free investing masterclass worth over $500. Check the details in the show notes below. And one final thing, if you're like me and you own ETH, and if you want some extra yield on your ETH, well, I just put some of my ETH into Kelp. Listen to this message to learn more about this.
Get ready because your reward farming game is about to level up. Introducing Gain, powered by Kelp, your DGen concierge. Gain is an automated vault launched by Kelp that maximizes rewards for ETH users. It offers one-click access to airdrops and points from leading L2s like Linea, Scroll, Karak, and more. Here's how it works. Head over to milkroad.com/Kelp Gain and spot airdrop Gain. Get a complete overview of how your assets are deployed and the rewards and points you stand to gain. With just a few clicks, deposit ETH or SETH or liquid staking tokens into the smart vault. That's it. The best part, once you deposit, you're issued a liquid token, AG-ETH, enabling you to participate in DeFi on Pendle, Spectra, Lyra, Splice, and others. Gain is already live and you can go check it out for yourself today. Just head over to milkroad.com/Kelp Gain and get started.
All right, welcome back. And as I mentioned, we've got Kyla on the episode today, and I'm really excited because just a quick disclaimer here. I read Kyla's book recently, all about macro, and it is one of the best resources to understand macro in a simple and fun way. It actually reminded me a lot of reading the Milk Road newsletter. So for our Milk Road fans, if you want to learn about macro, there's no better way to do it than reading this book. The link is in the show notes below if you want to check it out. But Kyla, thanks for joining us. And the first question I want to ask is just kind of high level. Walk me through where you think the economy's at. There's a lot of talk of, are we in recession? Are we not in recession? We're going to head into recession. What is your take on this whole debate that the macro world's having right now?
Yeah, no, it's a tough time for macro. Like we had a really strong labor market for a while, and we're starting to see a deterioration in the labor market. So the unemployment rate has ticked up. Labor force participation rates are up. Like people are in the labor force, which is part of the reason why the unemployment rate has ticked up. There's just more people who are looking for jobs. But you're seeing a lot of weakness in professional services. You're seeing a lot of weakness in tech and finance. You're seeing a little bit of weakness in hospitality and healthcare. And so it's just a tough time to find a job if you're looking for one. And on the other side, inflation has started to abate, but that doesn't mean that prices are going down, right? Like your box of cereal is still really expensive and it's tough. And so the Federal Reserve essentially had this meeting in Jackson Hole, Wyoming last week where they were like, hey, we're probably going to cut rates. And so that should provide some easing to the economy. That should make things feel a little bit better. But we are about to enter a new macroeconomic regime. And with that just comes a lot of change and a lot of difference and a lot of uncertainty, right? We're heading into an election in the United States, and that'll bring a lot of uncertainty too. And so I think the general thing with the economy right now is that it's uncertain, but there are a lot of concerning data points that economists are paying very close attention to, because if those start to deteriorate faster, there could be an economic downturn for sure.
So do you think, and I'm going to put you on the spot here, sorry, but recession or not recession? Are we in one? Are we not in one? Are we going to get in one? Or does it even matter?
Well, technically, we're always headed towards a recession, right? Like that's always the end state. But like in all seriousness, we're not in a recession right now. The way that we determine if we're in a recession, it's through actually a group called the National Bureau of Economic Research, and they look at a variety of economic indicators to determine this. So it's not 2 negative quarters of GDP growth, which seems to be what people think it is. That's not a recession. So the National Bureau of Economic Research will determine if we're in a recession, but there's quite a bit of lag to them determining that. They look at things like industrial production, they look at payroll, they look at basically all these things that tell us how the economy is doing, and then we know if we're in a recession. But because there's a lag to economic data, we often don't know that we're in a recession until we're in a recession. So we're not in a recession right now. We are seeing a weakening economy, but GDP growth is still strong. Inflation is going down. And any recessionary fears will hopefully be abated by the Federal Reserve beginning their rate cutting path, right? And that should help a little bit. So we're not in one right now, but technically we're always headed towards one if you want to be serious about it.
I want to talk more about that rate cutting path in a second, but just a quick question here. This talk of the soft landing has been a thing for, I don't know, I feel like it's almost 2 years now that Jerome Powell has said this.
Yeah.
And everyone has kind of been pretty hard on Jerome Powell for the last few years. It looks like he actually might land this thing softly. Do you think he's going to? And like maybe just give your opinion on what's going on with that.
Yeah, it's being a central banker is one of the hardest jobs in the world because you're tasked with something that's basically impossible, which is managing price stability and managing maximum employment. So basically, you have to make sure that things aren't too expensive, and anybody who wants a job can have a job. And that's like really hard. Like if you task me with that job, I'd be like, I don't even know what to do. And the toolkit that they have is limiting. Like essentially all they can do is nudge the economy in certain directions. They can cut rates to make it easier to get money. So hopefully the economy speeds up. They can hike rates to make it harder to get money. So hopefully the economy slows down. So I think Jerome Powell has done the best that he can with the tools that they have. But even at the Jackson Hole speech, he was like, hey, listen, the Fed thought inflation would be transitory. They thought it would go away kind of by itself. And that didn't happen. And the Fed made a mistake. And so he owned up to that. I think if they can strategically cut rates, if the labor market can sort of get a foundation underneath it again, like we probably will have a soft landing, but we'll have to see how the rate cutting journey goes to determine that. Yeah.
Not only is it a really hard job to do this, the pressure must just be insane because the moves you're making are dependent on hundreds of millions of people's lives. And not only that, it's not even just the US that the US impacts. It actually affects the whole globe. How do you even sleep at night? I don't understand how he does that. But I got to give him credit. It looks like he might actually manage the soft landing. We'll see what happens. But let's talk about what we think is going to happen here. You said, we're moving to a new regime, probably a rate cutting cycle. What does that look like in your mind? Is it September we see a cut, October, November? Walk me through what you think happens over the next, I don't know, let's say year or however long you think this new regime lasts for.
Yeah, so we're definitely getting a rate cut in September. That was basically what he said last week. Yeah, he was like, hey, and so that'll happen. The market is pricing in 100 basis points of cuts, and so we only have 3 meetings left this year, and so that would mean that at one of those meetings we would have a 50 basis points cut because they usually cut by 25 basis points, and so we'll see kind of what happens at the remaining meetings. But definitely at least 25 basis points in September, maybe 50 basis points. That's kind of what people are trying to figure out right now. Like how quickly does the Fed need to move? Because a lot of people thought that the Federal Reserve should have cut rates in July at their July meeting, and they didn't. And so a lot of economic people were like, oh gosh, now they're behind the ball again. So I imagine it might be 50 basis points in September. But either way, we're probably getting a 50 basis point cut at some point this year, and then maybe 25 basis point cuts. And then that will likely continue into 2025, that rate cutting journey.
Think that rate cuts are going to impact the economy right off the bat? The reason why I ask this is, and I mean, you know a lot about this, more about this than I do for sure, but in Canada, for example, I think it's 80% of mortgages are on a variable. And so you start cutting rates in Canada and it matters to a lot of people right away.
Yeah.
Whereas the US, I think it's only 10, I think is what I saw, or 15% or something is on a variable. So it's a lot smaller. Now that's just mortgage. Obviously rates impact a whole lot of other things. But what is your sort of take on when we cut rates? How big of an impact is it going to make on the real economy?
Yeah, that's a great question. I've made videos talking about how I don't think rate cuts are a good tool. A lot of the inflation that went away, and Jerome Powell even highlighted this, was because supply and demand normalized. Like we fixed supply chains and that kind of solved the issue. The San Francisco Federal Reserve released a research paper saying that like 75 or 70% of the inflation pressure that was abated was because supply chains normalized. It wasn't because of rate hikes. And it is, as you pointed out, because the United States we have a bunch of 30-year mortgages. So a lot of people are just like, and I think it's like 60% of people in the US own a home. And so they're not really that worried. And I believe it's like 38% of those people have just no mortgage at all. So, they're living free and clear, no worries. And so those people are insulated from rate hikes as an economic tool. If they have an auto loan, they're going to feel it. If they're trying to get credit, they'll feel it. So, I mean, rate cuts will definitely have an impact on the economy just because it'll impact businesses, it'll impact credit lending. Hopefully banks will loan out more money. That's an ultimate goal. But yeah, I mean, rate hikes have been muted in terms of impact just because of the economic circumstances of most Americans.
Right. So the Fed has one other tool other than rates, and that's basically just printing money, the balance sheet.
Oh.
So do you think the balance sheet is what's going to make a bigger difference here over the next little while? And how do you think they're going to use that over the next, let's call it, year or 2 years?
Yeah, so the Fed has been doing quantitative tightening, and that has been, basically pulling liquidity from markets, and that's been useful in some circumstances. And so I'm not sure if they'll enter like a pure quantitative easing cycle, but yeah, I mean, anything that they do with liquidity will obviously impact markets because that'll be exciting. So the balance sheet is always an important tool and one that doesn't get talked about as much as rates. But yeah, that could definitely be impactful depending on what they choose to do with it. They haven't really talked about it a whole lot yet. Yeah. It's definitely come up, but it's not been as noisy as rate cuts and rate hikes.
Yeah, for sure. I mean, we're seeing other countries use their balance sheet a lot, like China, for example, has really been printing a bunch of money this year. US, not so much. I imagine that's going to come. It just typically does in this part of, let's call it, the business cycle. But we'll see. You're right. They haven't really said much. It's been a lot of focus on rates. It was like inflation, now it's rates and unemployment kind of thing. And so I guess we'll sort of see what happens there. So, okay, we're going into a rate cutting cycle. Generally, that's bullish for markets, unless obviously a recession. But you said likely not recession. What is your take on just like overall markets as a result of what the Fed is up to right now? And I know that's a very general question because every market reacts differently. So feel free to choose the ones that you look into and value the most. Maybe that's the S&P, maybe that's the NASDAQ, maybe it's crypto. I don't know.
Okay. I was thinking the housing market.
Or that. We can just do that too. We can combine them all.
Well, I mean, the stock market has been like totally, I don't even know. It's like on its own journey right now. And, crypto, it kind of trades similar to tech at this point in terms of the NASDAQ. And so I think that, the stock market will be responsive to what the Federal Reserve does. We see, every meeting, the market will respond accordingly, determining on what the Fed says. The market is pricing in these rate cuts. So I think the market is expecting these rate cuts, but any sort of rate cut path is usually good for the stock market. And then in terms of the housing market, that'll be interesting too, because if they cut rates, mortgage rates here in the US will go down. That should help people who are, not trying to get into the housing market to be able to finance a home. So it just should free things up a little bit, like loosen liquidity. And that's always good for most markets. Yeah. Not a good time to invest in bonds though.
Yeah, 100%. But tech, stocks, real estate, probably going to be some sort of, I mean, they're already kind of in a bull market, at least tech is. Yeah. Real estate's not, but I think they're going into that world. Let's zoom out a little bit. And I just want to get your sort of overall view on the economy and the Fed and where things are going. We've obviously gotten a little bit crazy after COVID. We printed a shit ton of money and, things have been crazy up and down. These cycles have been a little bit wild, at least over the last little while since, let's call it 2008. What do you think's going on here? Do you think like everything's going to be all good with markets and we're just going to keep doing what the Fed's doing? Or like, do you subscribe to the camp of like, hyper dollarization where we're going to like hyperinflate away the US dollar? Or like, do you think like we're going to have to keep printing and printing and printing because we're so far in debt? Like, is there a scapegoat here? Like, what do you see as your long-term view of where markets are heading?
None of those things. Those are a little extreme. I mean, I think they're actually going to see the dollar weakening because of rate cuts, and that'll be interesting. The dollar has been strong for so long, and now we're going to see a different macroeconomic regime. And then, I mean, I think the government debt is definitely concerning. And, we have this election coming up, and neither candidate has talked about fiscal austerity at all. Like both are, they're campaigning. So they're going to talk about what people want to hear, which is spending money on services. And I do think that's quite concerning because, the Fed hiking rates impacted all rates, including the rate that the government pays on its debt. And so now interest payments are quite high. And yeah, and if you're spending money on that, like that's not productive debt. That's not a productive way for the government to spend money. So that's concerning. I'm quite concerned about the demographic crisis we're facing, across the world, not just in the US. I know Canada has similar issues. We just have an aging population. I believe it's right now, I think it's 17% of people are over the age of 65. So that is not sustainable. And the fertility rate has dropped to 1.8 and the replacement rate is 2.1. So people are just not having enough kids. And part of the reason that they're not having enough kids is because childcare is extraordinarily expensive. It's up 32% since 2019. And then on the other side of that, elder care, this demographic issue, is like $10,000 a month on average in the US. So I'm worried about demographics, not enough workers to replace or to support the people who will need Social Security and Medicare and Medicaid. So I think that's concerning. I'm quite concerned about the housing market and home insurance. Where Kamala Harris has proposed building 3 million more homes, which is great. Like we desperately need more housing in the United States, but insurers are entirely pulling out of California, Louisiana, Florida, and you cannot have a mortgage if you don't have home insurance. And so the government might have to step in and start backstopping these people's homes. And that's going to be an extraordinary amount of risk for the government to take on. And if we're talking about debt issues and fiscal austerity, that's only going to exacerbate the problem. So yeah, there's definitely things I'm worried about. But then I'm, always optimistic. I think innovation is the way forward. And there's been a lot of good investment with the CHIPS Act, the IRA, the IIJA. So hopefully things will be okay. But yeah, there's always something scary happening usually.
100%. I did an episode with Jay, I think 2 weeks ago, where I talked all about this demographics and the problem where we're all getting older and we're getting more and more in debt and we're not productive enough as an economy to get out of that debt. And my thoughts, and I'd love to hear your take, but basically my thinking is the only way we can get out of this is probably technology and more likely AI and robotics, which becomes a new demographic. Because I don't think we are going to get enough new people in the US to really make up for this. And I think the only way we can do it is if we can get AI to actually work enough for us that it makes us extremely, extremely productive. And then we can probably get out of this debt cycle that we're in. Otherwise, we, like you said, we kind of have no choice but to just keep printing money because we're not productive enough to pay for our debt. What's your thoughts? Is it tech that gets us out of this? Is there something else? Can policy get us out of this? What's your optimistic take?
I really hope policy can. I mean, some people will be we need immigration. And I agree. If we figure out immigration in the US, just across the world, I know it's a big issue in a lot of countries. That's great because more people are wonderful. And we're just not having enough babies and we have to have people coming in from somewhere. But China's slowing down, India's slowing down, the places that we would normally, take population from, they're also facing a demographic crisis. So I think immigration is a tough part of that too, because that's historically kind of what we relied on. And I think AI is definitely probably going to be the future, but I worry, and I'm curious if you do too, that'll just change our relationship to work entirely. That is going to be, I think, a new economy. And
100%.
I don't know how that'll work.
I don't know how it'll work either. So it's definitely a scary thought of okay, now just AI does all the work for us.
Yeah.
But I think anytime we've had tech, new jobs come from it, right? AI is not just going to go and do everything. We're still going to have new jobs, I don't know, new types of engineering jobs and new types of whatever it is. And maybe we'll just have to think about work differently, which I mean, we already do because of the internet.
Exactly.
The internet made the work life very different than what it was back when our parents were working, right? Or our great grandparents were working. And so I think the same thing is going to happen here with AI. I have no idea how it's going to play out, but I'm also take the optimistic route where I think humans will find a way to make this work, and hopefully it gets us out of debt. But that one I'm not completely sure on, which is why I love crypto so much. I don't know your take. What is your take on crypto? Actually, you don't talk about crypto a ton, but I know you had some time with Bankless.
Yeah,
He's friends of
yeah.
ours, and we
Oh,
worked with
great.
them a ton. So we love Bankless. I'd love, as we start to wrap up, we've got your macro thesis. What is your take on crypto? You talked about it a little bit in your book, and I was like, I don't know if she really likes it or not, but I'm going to put you on the spot here because everyone listening here is a crypto person. So
Okay.
watch what you say.
Okay. Yeah. Crypto people. No, I own Bitcoin. I own Ethereum. I dollar cost average into both of them. Like in 2021, I was like super into crypto. I wrote a lot about it in my newsletter at the time, and you can like go back and read those pieces. Like I was extremely excited, and I thought it was just so cool. I think my biggest thing with crypto right now, and I think most people kind of agree with this, but it's tough to navigate, is like it's lost the plot a bit. Like, advocating, like it's good that it's being a part of ETFs because that's adoption. Institutional adoption is important, but I just worry that is a deviation from the original ethos of crypto, from what the original creators would have wanted with Bitcoin. Or creator, I suppose. Well, we don't know if it's one person or more, but yeah. So I think that's like my biggest sad part, is that I wish it could have survived without the need for like BlackRock and the other people to take part. Yeah.
Well, TradFi always wants a little bit of something, so we can stop them, I think. But
Of course.
I feel you. We want the ethos of crypto.
When that's how you get
remain.
that's how you get proper regulation, right? Like that's the tough part, is the only way that crypto would be allowed, I think, is if the institutional players, and even then it's still like, you're battling the SEC, and it's like the BlackRock owns it. Come on. So yeah, it's a bummer, but
yeah,
I still own it.
Okay, well, that's good. Still bullish.
Boys.
So as we wrap up here, let's just go back to your book for a second. And I don't know if you have any specific takeaways, but again, the book is basically explaining everything you need to know about macro. It's like a macro masterclass, right? To get you up to speed. And so our listeners here have been learning macro. We've been trying to teach them over the last few months. We've really dove into it to like help people just wrap their heads around what macro is, why it matters, how it impacts markets. Is there anything just like advice you can give, or maybe just some takeaways from your book in terms of macro, just to help the listener sort of like wrap their heads around a little bit further? And I know that puts you on a spot a little bit, but maybe you've got something in mind here.
Yeah, I don't know what you all have been, sorry. I don't know what you all have been talking about, but like, I think the biggest thing is like inflation going down doesn't mean that prices are going down. Like that can be kind of sticky for people. So when you hear inflation is going down in media headlines, like that doesn't mean that things are getting cheaper. And then I think there's also cyclicality to business. Like business cycles are cyclical, obviously. And so it is to be expected that there's going to be an eventual downturn. But there's both fiscal and monetary policy to help abate some of that, monetary policy being the Federal Reserve, fiscal policy being the government. And so I think that there's a lot of important things to know about macro. And I'm really glad that you all are talking about it, because for whatever reason, we pretend that people don't need to know about macro, even though it impacts like everything that they do. So yeah, I'd say those are probably the three top things: is inflation, cyclicality, and then the policy solutions that are available.
Yeah. Understanding macro is so important, not just to invest in crypto, which is the context we generally give, but like we talked a little bit about real estate, and I just bought a house about a month ago. And thank you. And understanding macro really helped me decide on when to buy a house. I was going to buy it next year, and I was like, oh wait, rates have already come down twice in Canada.
Yeah.
Yeah. So I was like, okay, the real estate market's about to pick up. Like now I should buy it. Right. But we put in the offer, we got it approved, but I'm not closing until later this year. So I get 3 more rate decisions. It's like, I don't have to lock in until rates have gone down. And everyone's like, what are you doing? Why are you doing that? And I was like, when you understand macro, this all makes sense, right? There's also like managing your business. If you understand the business cycle, it really helps you understand when to hire, when to let go of people, when to be spending on growth. So understanding macro, it's something that all citizens should just actually understand, whether you're an investor or not, because you're probably someone who works at a business or is buying a home or hopefully buying a home. So it matters for a lot of things. So anyway, kudos to you for writing the book. It's very, very helpful. I highly recommend others check it out. But Kyla, thanks so much for joining us. It was great to have you on here and great to hear your thoughts around macro and what the Fed's up to. Super helpful.
Yeah, thanks for having me.
As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.